Hey guys, it's Nick, and in this video I want to talk about if you should buy silver, and if you should buy it because Goldman Sachs says that it's time to buy it again. In this article from Barron's, one of their analysts, Mikhail Sprogis, is saying that silver is going to benefit from a global solar energy drive, and so it's time to get back into silver. And he says it stands out as an obvious beneficiary. And so apparently there's a lot of silver used in solar panels, and solar investment accounts for 18% of silver industrial demand, or 10% of silver total demand. Now, that could be, but he's basing it on Joe Biden's plan to install 500 million solar panels in the US in the next 5 years, which could boost global installations by 15%. So that's a couple assumptions. One, the assumption that Joe Biden wins, and two, if he does win, he actually goes ahead with these 500 million solar panels and all of that. When I hear articles like this from big banks, especially like a Goldman Sachs, I usually think the opposite of what they say, because when somebody is pitching it so obvious like that, in my mind, they're usually taking the other side of the trade already. And Goldman Sachs is kind of known for that. Like, for instance, in 2008, when oil went to $140, they came out and said it's going to $200. Well, of course, that was the exact top of the market when they said that. So they were probably short when they came out with that statement. So anyway, I wouldn't buy silver just based on what Goldman Sachs projections about solar panels are. But there are some other obvious reasons on why silver and gold should do very well in the future. And so if you don't have silver and gold, you should really consider getting some. Now, full disclosure, I own silver and gold, and I'm bullish on it, and I think it's going to go a good amount higher from here. So take that with a grain of salt, whatever I say about this, because obviously I'm talking my book. So in my mind, a better reason to buy gold and silver is because things like this, you've seen recently that Americans have saved up a whole lot of money around April and March because they were staying home. But now they are out and they're blowing all that money, so they're back to being broke. And so here is the personal savings in billions. So you see, before the shutdown, it was running around, what is that, about $1.5 trillion. And at the peak in April, they had personal savings about $6 trillion. And once the shutdown kind of opened up, it's now all the way back down to $2.4 trillion. So all the money that they saved up, as soon as things opened up, Americans were tripping over themselves to spend it all. And here's another visualization of the personal savings rate. So it was just chugging along for the last 7 or 8 years, around 7% or so. During the shutdown, it went as high as 33%. And now it's all the way back down to about 12% or so. And I talked about the digital currency that the Fed wants to do in another video, where they have an account for you at the Fed, so they could put the money in there directly so that you can spend it quicker, so that they can create inflation quicker. Here's an article from Jeff Gundlach from Double Line, and he's a high-profile asset manager, and he says that the Pandora's box of central bank digital currencies, in which it echoed our claims that such a mechanism could open veritable floodgates of liquidity into the consumer economy and accelerate the rate of inflation. While central banks have been trying without success to increase inflation for the past decade, the temptation to put CBDCs, which is central bank digital currencies, into effect might be very strong among policymakers. However, CBDCs would not only inject liquidity into the economy, but also could accelerate the velocity of money. That 1-2 punch could bring about far more inflation than central banks bargain for. So they are trying everything they can to increase inflation, and they said that they're no longer even going to try to target inflation. They usually, if it gets above like 2%, they try to do something to tamp it down. In this case, they're not even going to try to do that. They just want it to go up. And if you do that, it could run away from you pretty quickly in some cases. Here's a graphic of what the government takes in and what they spent for fiscal year 2020. And you see that their total receipts were 3.42 trillion, but they spent 6.552 trillion, or I guess they expect to spend for the whole fiscal year of 2020. So that's about 90% more than they take in. So it's like saying if you made $34,000 a year and you spend $65,000 a year, how long can you afford to do that? Not that long. And here's a visual graphic of the budget deficit each year. So the budget deficit is how much you spend more in the calendar year than you make that year. So here, the last, 9 years or so, the budget deficit at the end of the year was somewhere around $1 trillion more than they took in. So if you take in 50,000 and you spend 60,000, your budget deficit is 10,000 for the year, let's say. But here, 2020, you see that it's like triple almost the most biggest deficit that we had on record in the last 9 years. So this thing is getting out of hand, and there's no sign of this slowing down. As you see, with people's savings rates are gone, so everybody's expecting more unemployment and all kinds of other stimulus kind of deals. And both Republicans and Democrats are willing to do more of it, it seems, and in bigger and bigger amounts possibly. And this is the percentage of debt to GDP. And right now we are at around 130% in 2020, and it's projected to be somewhere close to 200% in 2050. Now, I highly doubt that it will take 30 years to get to that level, the way they're spending now. Japan and I think maybe Italy is at 200% of GDP, debt to GDP. I wouldn't be surprised if we're there within 5 or 10 years or so. So this crazy spending is accelerating, and I don't see any sign of it stopping. So if you decide to invest in precious metals, whether in physical or ETF form, just decide what percentage of your portfolio you're willing to risk. And of course, don't bet the farm on any one thing, whether it's precious metals or real estate or stocks or Tesla or whatever you want to invest in. It's wise to have a little bit of everything, and that way you don't have to be right all the time, because you never will be. So that's my look at precious metals, and specifically silver, because if there is a run up, silver usually runs up a larger percentage than gold does. So if you don't have that much to invest, I would recommend silver instead of gold. If you like this video, please give me a thumbs up and subscribe to my channel if you haven't done so. Thanks for watching, guys.